great panel because they got in a lot earlier. So I think when we do our 2-minute introductions, what I'd like to do is not only give a background of yourself, but also when you got into this field, because there's a heck of a big difference if you bought Bitcoin at $50, $60, or $70,000 versus one of the guys on our pre-call said $400 for him. So he probably still looking pretty good. So what we're going to do is 2-minute introductions. In my case, I'm just going to give a quick pitch for the most recent venture where I joined the board, and that's Symbia Mobile, which is a mobile app that connects first generation college students and their parents with a mobile app to the colleges. And kids only read texts, so the school uploads a whole file of their transcript, and then there's a meter there that shows how they're meeting the requirements for the University of California system. And so far they've got 7 of the 9 UC systems already signed up. So that's a pretty good deal because as you know, in California and other places, around 70% of the colleges are now SAT optional. And so there's no real way other than in-person recruiting to find out and get to the high school student. And to show you what a big market is, a static list with just the names of the people and their SAT score, the college boards made $500 million a year. So that's a big number. And we think this is going to be a real big opportunity later on when you go to the East Coast, because the East Coast has all the colleges, many of them, 2nd and 3rd and 4th tier, but still pretty good colleges that are losing students because all the college age students are moving with their family to the western United States where there's no water. So that's sort of what's going on in the country. So that's it for me. So now I think what I'm going to do, I'm first going to start with the guys that came here, give them some credit. Tim, I think I'll start with you, and you can give us a quick introduction to yourself, and once again, when you started getting into this business.
Thanks, Gary. So my name's Tim Ryan. I'm a partner at Vibe Capital. My other partner, Dave, was on the venture panel a little bit earlier. So my background is pretty entrepreneurial. Was at a sports tech startup from 2010 to 14. We did some work with like the Giants, PGA Tour, tennis, things like that. It was a MEMS gyro accelerometer, similar to like a Fitbit. So we did like 3D motion tracking technology, and then it paired with Bluetooth for your iPhone. So we're selling it was consumer kind of wearable product. So we sold into Apple, Verizon, Best Buy, and at our peak, we're doing about 15 million ARR. Did multiple rounds of fundraising after that. I ended up leaving, started a health tech in the medicinal cannabis industry. We partnered with some lab facilities in Berkeley, Marin, Sacramento area. I stayed on as a board advisor, ended up selling my shares, and then got deeper into the Web3 space. The first time I read the Bitcoin white paper that Satoshi Nakamoto, the anonymous, pseudonymous writer or writers, was I think 2008 or 9 when it was released. But I think it was like 2011 when I read the white paper. There were some meetups in the Mission District here. A lot of the early founders, like Brian Armstrong was there from Coinbase, the Kraken founders, Armstrong, Jesse was there, a number of like Open Bazaar, things like that. Even Vitalik, I think he was doing Bitcoin Magazine. He was just a publisher at that point. Later on, he was doing kind of a roadshow to do his initial Ethereum launch. This was down in Palo Alto. It was like the Center of Innovation or something along that. So I remember him literally laying the roadmap with milestones for where we are today. And, it's taken some more time than we've thought, but he's pretty much, done, or his team has done what they said they would as they've migrated from proof of work to proof of stake. So I do think it's very early. I mean, the internet, now all the global commerce and transactions, travel, all that stuff's done through the internet. But 50 years ago, nobody even knew what the internet was. And I think we're kind of at that stage now.
So, Tim, later on when we get into the depth of it, so you want to explain what proof of work versus proof of stake is, because that's a important thing and not everybody's followed the nuances. Sanjay, go ahead and tell us your story.
Yeah, thanks for having me, Marty. So I'm Sanjay, head of Web3 at Roofstock. Roofstock is a prop tech company specializing in the single family rental space. Since inception, we've done about $5 billion of GMV through our platform, servicing both retail and institutional clients. Last year, we sourced and acquired north of $2 billion for our institutional investors. So we're kind of the premier SFR single family rental platform in the country right now. Web3 is super interesting to me because if you look at Web 1, it was just sort of read-only internet. And then Web 2 became read-write, and Web 3 is now read-write-own. And it's, in my opinion, the technology stack that's going to be dominant in the next 10 years or so. And what makes it super interesting is that you have obviously the concept of smart contracts that Ethereum is really famous for. But in the old days, those smart contracts worked with programmable money, which was also Ethereum, which is a cryptocurrency. But in 2018, Circle, in collaboration with Coinbase, launched.
Goldman Sachs.
Okay, Goldman as well, launched USDC, which is a stable coin pegged to fiat. And for the first time, we actually had programmable money that could interact with these smart contracts and really disintermediate a lot of the traditional intermediaries in the system. So we feel that this is going to capture a lot of value back to the consumers and disintermediate large incumbent industries. Specifically, we see a lot of use cases in the real estate space as well. I've been in the crypto space since 2017. And I've seen how it has evolved since then. Back then, Bitcoin was around $3,500. And then, of course, it went to its meteoric, 60,000 rise, and it's back down to 20 now. But when you're looking at individual cryptocurrencies, it's hard to predict which one's going to be the winner. I think at some point in the future, a spot ETF would be really nice. But as a technology infrastructure platform, I think Web3 is here to stay, and would love to talk about all of that. I also have a prior background as an investment banker. So from TradFi, I've moved on to become a DeFi degen. So I'm happy to talk about Howie, Gary Plastics, Reeves, Williamson, V. Tucker, any of those securities laws issues, as well as anything on the Web3 space, NFT, Metaverse, so on. Thank you.
Okay, so now I'm going to call on Rich Gupta. So Rich was kind enough to set up our pre-call 2 days ago. And so I've actually now get to see him in a stable environment. He was taking a walk around the Westlake golf course, and we got a good tour of the golf course, didn't we? Or the park there, but we couldn't, you were just bouncing around. So thank you for doing that. And why don't you go ahead and give your introduction?
Thank you, Gary. And thank you, Marty, for arranging this seminars and conference. You do an amazing job, Marty. Yes, I was in the Westlake area and walking back to my office, and we had a call set up and I had to take it. So you do whenever you need to do. That's what we learned in the Wall Street. After spending maybe 20 plus years in various capital market groups, transaction groups, left all that and came out to West Coast to create a asset management firm around 2005, 2006. And then we all know what happened in 2007, 2008. Since then, basically became independent operator, assisting private growth stage companies, investing, started with Fintech only because that was the only background we had, and dabbled into health tech. And then later on, around 2014, got involved, started by a friend of friends who came to visit us, and he insisted that I should definitely get involved in the crypto assets. And in those days, in 2014, there was only one, Bitcoin. And then Ethereum came down the road and the world opened up. And I think Gene talked about earlier conversation about the ICO fiascos we had all seen and not participate. So since then, we became a loosely aligned 7-member multifamily office where we focus pretty much in later growth stage companies on fintech, health tech, and also in any crypto assets. We invest our own capital. And obviously, if our capital is not big enough, we go out, since I'm still registered, we can also assist through additional capital to that. And that's it, Gary. So you got others to go on.
Okay,
Thank
well,
you.
that's great. So we also have Robert Levin, who I guess he's somewhere in the metaverse. We can't see him, but if he's trying to get on now, please chime in if you're on the phone or something.
He's not in.
He's not in. Okay, so much for that. Okay, so the way we'd like to do this, we're going to kind of divide it up into, 8 to 10 minute speeches here. But one we wanted to start with, first of all, will be the crypto market, and then we'll move over to the metaverse and the three pieces of that, which is really the platforms, the projects, and the games. So those are going to be more interesting because I don't think too many people really know what those are. But what I think I'll do here is, first of all, let Tim start off, and maybe you can tell us what seems to be one of the bigger changes in the word proof of work versus proof, well, where is it? Proof of stake versus proof of work. So maybe you can tell the difference, because that and the Ethereum seems to be the biggest thing other than, price declines in the crypto world.
Sure, thanks, Gary. So proof of work at its core, Bitcoin, Ethereum, they're all just technologies similar to Linux or any other code base. There are financial layers built on top of that, and I think it's like an application layer. So it's very important the way that these transactions get kind of batched, processed, and then I'm talking like from a very technical level here. So if it goes over or it's too nuanced, just please let me know. I can stop and explain. But as these transactions, this is from the core original OG code, I guess, the Bitcoin code. So they're batch processed, similar to how you would take like data from a server farm and then process that if you are Amazon or Meta or Google or like Azure Cloud, things like that. All of that gets processed, and then from there they're sent out to these nodes, right? And the nodes are incentivized with financial incentives, which is a Bitcoin, right? And so one Bitcoin, initially it was worth nothing, and then there was Bitcoin Pizza Day, where somebody paid 10,000 BTC essentially for a pizza because they wanted a pizza. And so that created an actual transaction, and it also validated the currency. And from there, then we were off to the races. So the problem with that, though, is that from, it's grown and grown, and, from a couple pennies for a pizza to $1 trillion now or whatever it is. It's very, very energy intensive, and to do these transactions, you have to do ASIC miners. That gets more competitive because there's it's an algorithm essentially that you're trying to solve. So in the beginning, if you were a gigabrain, you could just solve it using pure math. But as it gets more and more competitive, and that's written into the code, it creates more and more demand and resources needed. So it goes from ASICs, then you need GPUs, and the Chinese miners built a bunch of like ant miners, which became like $1 billion industry until China shut that down. So the long and the short of it is it's very, very energy intensive, but that's a cost, and that's intentional. It's a feature, not a bug. And the reason being is that if there's no downside risk, then there's no upside either, right? So you need to have expenses, like you need to actually set up these server farms or miner warehouses or whatever you want to call it. And the trade-off is that if you want to invest in that and create the resources, then you're going to be incentivized, and you can make some of these profits and sell them. And then from initially, the miners would, batch process those. They would get a reward, a Bitcoin reward. And then from that, then exchanges like Coinbase, you may have heard of, I think they went public a few years ago. those exchanges made a marketplace, kind of like the NASDAQ or New York Stock Exchange or one of those, that essentially creates a marketplace where people can transact and buy and sell currencies. So that, I mean, I'll pass it off to Sanjay for maybe proof of.
Sure, I'll add to that, right? So in the old days, or at least Bitcoin still works this way, proof of work, basically, in order to get the right to write the next block of the blockchain, miners across the world are trying to compete to solve a really complex cryptographic puzzle. And so there's, like, you can imagine innumerable number of computers trying to solve this, but the first one to solve the puzzle gets the right to write the next block and then claim the reward for itself. So there's, potentially tens of thousands of computers trying to solve this one puzzle to write the next block, and that wastes a lot of energy. Proof of stake, on the other hand, is you come in with, like, I think in the case of Ethereum, it's 32 ETH, I believe you need to, and you just take that and say, I would like the opportunity to solve this puzzle, and Ethereum randomly picks one of these validators to solve the puzzle. So instead of every computer in the world competing to solve that one puzzle, the puzzle is given to a specific validator. So that conserves a lot of energy. Ethereum started out as proof of work, just like blockchain, Bitcoin, and then very recently they finished the migration 9 years later into proof of stake, which is the first step in the scalability of Ethereum as sort of the technology infrastructure for Web3. And the next steps of that include what Vitalik calls as, basically getting like sharding, which will increase scalability with ZK rollups and other complex topics. We can go into that in as much detail if anybody is interested. That's right. That's right. So, but to summarize, proof of work versus proof of stake is, one was very energy intensive, lots of computers trying to solve a puzzle. Proof of stake, a single computer solves that puzzle. So it's energy efficient and a lot more scalable.
Can I just add one more thing? So we were at the Stanford Science of Blockchain conference two weeks ago. Dan Bona, he's applied cryptography director at Stanford. I've taken a few courses with him as well. He's got a bunch of postdocs. A few of them have spun out their own chains, Findora chain, Harmony. You can look at these on CoinMarketCap if you want to do your own research. I highly recommend looking at some of those, but a lot of very technical, it's still at the very technical layer. So in 1990, if you wanted to send an email, you needed to be it was not simple. It's not like you just sign up for Yahoo Mail or Gmail and send an email. And so I think Google has built that value, and they've built a $1 trillion business out of that, right? And Gmail and Maps and many other things that we use without even thinking about it. But that, when Larry and Sergey came out of Stanford in '99, out of their postdocs to drop out to found Google, I think, the early investors, whether it was Kleiner or whoever, it was very, very small. It wasn't what it was today.
Gary, I'd like to add to that what Sanjay and Tim talked about. I think I predominantly agree with most of the conversation. I would like to make one adjustment to it. When Tim was talking about batch process, there is no batch. It's every 10 minutes a block is being run. As Sanjay explained, is through the computers and through Antminers or miners or GPUs. They're constantly running to solve the equation, and whoever runs it first, every 10 minutes, a solution is solved and a block is written. And currently, whoever the miner is, they receive 6.25 as a reward on a Bitcoin. And that's the intensity which goes on to the power generation. It has caused a lot of complication, but majority of the mining currently is being done at either hydro or natural power.
Yeah, okay, we'll get it. Okay, so we're going to go a little bit more on to the business here. And I think that we can cover this one quickly. The Bitcoin miners really getting hosed because there's problems in Texas. But before, my understanding is that you could get free electricity as long as you had the pipes, because the natural gas was being flared, and you could then, saving methane if you use it. So instead of guys consuming vast amounts of energy. So maybe since you brought up that topic, can we quickly cover that in terms of, is there social purpose to a Bitcoin in terms of energy consumption?
Well, utilities tend to love miners because the miners are able to throttle up and throttle down on the capacity. Prior to China banning it, China was pretty much mining on power, which we are always looking negatively on, which is not thermal or which is not green technology. But the power usage of this whole gas flaring is a new phenomenon. It opened up a new technology for US based and globally, wherever there is oil being extracted, the gas is the second product comes in. And what miners have utilized the resources with the new technology as a containerized system. I mean, you can literally put containerized system of 1 megawatt to 10 megawatts right next to the power plant on the gas site. And then you start the mining and you bring in all the connectivity. But the biggest challenge for miners have been is the Ethereum. Ethereum mining has stopped. So it cut down almost 30% of the revenue of the miners.
Can I just add one more comment to the
Sure.
business use case? So it's an excellent point. We made a seed investment in a company called Vespine Energy. They're right across the bay in Berkeley. He was working on nuclear subs and stuff like that before. But currently what they do is they cap methane emissions on landfills and then using ASICs and mining rigs, essentially convert that negative energy. It's just currently 70% is just freely emitted or flared. And they convert it into an energy resource. So Intel's interested, a number of other companies as well for powering their data centers. So Polychain Capital is a big Web3 fund. They were a co-investor. So is Founders Fund, that's Peter Thiel's fund, and a couple others as well. But just as a comparable, I think Crusoe Energy is in Colorado area.
Yeah.
They were invested in by Chevron at like 1.2 billion or something.
So let's go to a little bit broader topic. You know, many people think crypto is a speculation on speculation. But you know, Sanjay suggested this question that, you know, that the crypto is highly correlated with the equity markets, which it wasn't supposed to be because it was, you know, the addresses were going to grow exponentially. And so now we're seeing that even though there's distressed times, people aren't running to crypto. You know, they thought the Ruskies would be able to get all their money out but now they found out whatever systems they're using, they can only get $250,000 at a time out. So that kind of cut down their, you know, their interest in that. So maybe you can talk about that in terms of the correlation, because a lot of the old saws about being, you know, really growing forever really got beaten down. And I guess Rich suggested the sixth crypto winter. And so is it now a time to invest? Lots of people who just talk for a living on guys like Fast Money say, no, we got to wait for a while till it gets down to 14,000 or 10,000 or whatever. So why don't you give a little bit of investment theses on that?
Sure, and this is not investment advice. By the
Okay,
way.
no, it's not investment advice.
You know, when you sort of think about when you go to a supermarket and you see a sale, right? Something's off 30%, everybody flocks to buy stuff. But somehow in our equity markets and crypto markets, when we see the market decline, there's this just fear factor, right? Nobody wants to touch it. So I think that's sort of fascinating because I think it's time to buy equities, like, you know, and it's time to buy crypto. They are correlated today, and that's because, you know, and I think the only way that correlation goes away is if there's a spot ETF and it allows like vast majority of people to look at crypto as an alternative asset class and get into it, because otherwise it's the same people who are highly invested in the equity markets, corporations, etc., that own a lot of Bitcoin and Ethereum, and so those tend to move with the market. In fact, their volatility, on the other hand, is probably even higher than the crypto market. So, the stock market. So, you know, S&P went down 20%, you'd see Bitcoin going down 50%. But the same is also true on the other side, right? It tends to rise higher and fall faster as well. I do think eventually there will be a spot ETF. Bitcoin is a commodity that's already been accepted by Gary Gensler. I think the CFTC will make a claim on several other cryptocurrencies. And at that point, once it's a commodity, I think we'll see a spot ETF come in. And once the average person is able to buy small allocations to a diversified pool of crypto assets, we'll start to see that asset class slowly get non-correlated from the equity markets. Now, having said all of that, I sort of want to point one thing out, like all of us here use the internet and nobody here cares about the hypertext transfer protocol, right? Like that's the technology stack that runs the internet. Nobody cares about it. And the same is true of Web3. I think there's innumerable number of business use cases and we can talk about all of that. And none of us really need to know anything about blockchain or cryptographic puzzle solving and all this other stuff.
So I just want to make a comment. So Aaron, it kind of fits into what you're saying. So we have had SB Angel, Mark Humphrey Group speak, and also Bob Bozeman, who was one of the founders of SB Angel. And so it was probably 2009. We were asking him about some technology. I don't remember what it was. Nanotech.
Oh,
He says,
yeah.
the thing about nanotech is not really a strategic advantage, it's just infrastructure. So we just assume we're not paying for it. We just assume it's going to be in everything that we buy. And I lay that out as the same argument for AI and machine learning, that you're just going to assume it's in there in 5 years, and there's probably not going to be an incremental amount of profit for you if you're selling AI tools, right? And I assume the same thing about Web3, although I'm a big proponent of it. There will be some winners, but not as many as people think, because there has to be buyers, right? But
Yeah.
Again, as you just said, it's going to be infrastructure. You don't pay attention to it. It's just there.
That's right. Yeah.
You assume it.
And then of course, when you talk about specifically Bitcoin or ETH, those are cryptocurrencies, and you're buying and selling because somebody's long, somebody's short. And now you also, for Ethereum, you have options available. So you can come up with delta neutral strategies. You can go long and short at the same time. You can do all that stuff. But what I'm focused on more is the application layer, because there you can use this fundamental technology to radically transform how certain businesses get done today, right? Like I'm in real estate, where buying and selling a home, there's a 6% brokerage commission, probably 1 to 1.5% closing cost between title and escrow and notaries publics and this and that. And I'm using Web3 to figure out a way to buy and sell single family rental assets on NFT marketplaces at a fraction of the cost, and literally almost instantaneously settle those trades, right? And that can be done today because the underlying technology allows you to disintermediate the people that are traditionally rent seekers in this ecosystem. But those are the kinds of interesting things that are happening in this industry. Right?
Mediation is a tough game.
Yeah, absolutely.
Can I add one comment just on infrastructure? So if anyone has an iPhone or Android, I'd say 4 billion people maybe now use these devices. That's what's going to happen with Web3 at some point. And if we're wrong, we're wrong. It's $1 trillion. The global equities are 100 trillion, but I'd rather be early than late personally.
The Apple brand has paid a lot of money from the iPhone.
Right.
I don't think the suppliers have made much money.
No, I'm not saying that, but the way we're talking to, Zoom was able to build an Apple iOS application because they own the operating system. There's multiple steps that need to happen in this chain before we get from A to Z. But my point being is to Sanjay's point, and the other panelists, we're building the infrastructure as we speak, and whether it gets built to what it could be, we don't know. But if you could bet on Apple in the 70s or Microsoft in the 70s, we don't know. And I'm a venture capitalist. I'm trying to make some of these bets, in this industry. But as one of the previous panelists said, 95% are going to be wrong anyways.
If I was a venture capitalist today, I would be investing in who's going to be acquired.
Yeah.
It's interesting.
Yeah.
So we did have Bob Bozeman, he's the first investor in Google. They invested, $250,000, and they got 30 million back. And so he said the only reason why Google came in was because they had invested in Yahoo.
Sure.
And Google wanted to be acquired by Yahoo.
Yeah.
So
if I can make one point, Gary, on correlated asset comment. Yes, in a distressed market, everything gets correlated. Show me a distressed market where things were not correlated, and digital asset, which is we're talking about Bitcoin, Ethereum, and others is at infancy. And as the regulations and legislations get more clarity, more participants will come in, more institutional participants come in, and that's the time you will start to see the bifurcation. Instead of Bitcoin just being a payment or store of value, you will definitely see, because the value of Bitcoin is only 21 million. That's it. So as the more participants come into play, the structure of Bitcoin as a store of value will grow, and potentially it will compete head-on with gold or other assets, which are so-called safe asset or store of value assets, and time will tell. But infrastructure, regulations, and legislation must change before that.
Well, okay, so we've had a good discussion here. I know we've got a long session on the metaverse, and I think the post child, was basically Facebook, which I'm still continuing shorting. I basically think that's the only thing I don't want to. It's about the only thing I look back and say, boy, I should have shorted more than I did. But there's 3 topics there really, and they are where's our topics here? The topics are platforms, games, coins, and where's the other one? I can't find my sheet here. Where do we put them? Okay, and platforms, projects, and games. So I think in order to get all this done in 10 minutes, the best thing is I'm going to kind of auction these off, okay? So who wants to do the platforms, and who's the first one? Who wants the platforms? Okay, go ahead. Sanjay's going to volunteer for the platforms, and so we'll let him spend several minutes on an in-depth discussion,
Okay.
and then if anybody wants a quick chime in, that's fine.
So I'm going to take a slightly contrarian position here, right? I believe there is a place for metaverse. I think it's in the future. I don't think it's a very evolved segment of Web3 today. And the reason I say that is because probably the 2 biggest platforms people talk about in terms of metaverse today are Sandbox and Decentraland, right? And at the peak, they had about 300,000 monthly active users on those platforms, which is really tiny if you compare it to any Web2, successful Web2 company. And Sandbox, I think, was also perhaps valued at $4 billion back then. I read something recently that these platforms now have less than 1,000 active users per week, right? And largely that's to do with, when you kind of think about Web3 assets, where it's, as I mentioned earlier, it's read, write, own. And so the creators and the consumers both share in an economy. And unless the community sees some continuous value in a platform, it's not very sticky, because they can take their assets, which they own, and they can take those assets to some other Web3 platform. The only kind of pre-metaverse success I'm seeing so far is with Other Side, Other Deeds. I think Yuga Labs is talking about building out some metaverse experience in the future. Other Deeds have really held their floor. And, so that's kind of where I see a lot of the action today in the metaverse space, and maybe Tim has a different opinion. But I don't really feel that, at least today, like looking at Decentraland and Sandbox, that particular part of the industry is doing so well. Having said that, though, I think in 10 years from now, we could radically see entire industries revolutionized with the use of metaverse. So, for example, the teachers in California, I think it's an aging population, either average or mean or median age is in the 50s. Once they retire, there's probably not enough younger teachers coming to take their place. And you could see applications of metaverse where there's an immersive augmented reality experience for kids in the future and things like that. So I do think the future is pretty bright for metaverse. I just don't think today there's anything concrete going on. Tim?
I'll add on that and kind of take if that's okay, take the games part of it. So I'm kind of aligned with Sanjay. It's very early in the sense of metaverse, similar to blockchain or Web3, very nebulous in what it is and how people define it. Even Meta did their change from Facebook for stay out of the spotlight on some things. But regardless, it's going to take some time for all of this infrastructure to be built out. What is metaverse? I think everyone needs to define that themselves. Like, is Zoom a metaverse? Like, technically, I would say yes, because it feels like these three, colleagues, participants are in the room with us here. It's not like we can go out and shake hands with them, but it's a very seamless experience. And so as it, continues to grow, and Zoom is a couple $100 billion or half of that because of the equities, it will continue to develop resources and develop on new platforms. Oculus headset, which is a VR, which stands for virtual reality. So they acquired Palmer Luckey had developed Oculus. It's a gaming headset. There's also some other educational applications that can be built on top of that. So as you really need that core developer community to like Android and iOS, they have just thousands of developers that build on top of that, and then that's what creates the actual enterprise value.
What would be good, because you kind of have to know the players, kind of like the transfer portal in football today. Is there sort of books or literature you'd point out if somebody wanted to kind of capture this all in one place?
I think my go-to for crypto is crypto Twitter. I follow a lot of people on Twitter, and that's where I kind of get most of my, what's going on in the space. I also use Telegram. I'm part of some groups on Telegram where there's a lot of crypto information shared.
I mean, that's true. There's a lot of articles written on these. If you just search on the web for education material, there's a lot going on in Metaverse and Web3 as a whole. And I know you want to talk about gaming in the next topic, but I think Sanjay alluded to with the teachers being as a participant down the road as education software. I mean, we got involved at a very start on a gaming technology using similar to Metaverse technology, but real teachers teaching math. I mean, math teaching is so broadly not recognized in America, at least, and we are focused on that, changing it. And hopefully that technology will improve. The biggest challenge for Metaverse, and I think Tim also said, is the infrastructure. The Metaverse infrastructure, Web3 infrastructure, still is not as solid as it could be. It will take time. And the gaming industry probably most likely will become the biggest tool for this industry to expand into, other than, all right, so you bought a land on Web3 or you own a Metaverse and you own a part of the museum, a Louvre or something. God bless you. I don't think there's a play there, but there's a lot of money going in to create New York City on the web, or as well as Metaverse, or San Francisco on Metaverse, and people are buying it. But that's not our team.
So I think we've only got about 2 minutes because Marty has got a plane to catch or something, but he's, how many minutes do we have?
-1.
-1. Well, okay, so we'll have to be continued. So I guess I thank everybody for being here. I guess we've got the room for another half hour or so.
Probably 5 minutes. But why don't you wrap up, ask everybody, what their parting thoughts are on crypto and Web3 and what you should be looking out for.
Okay. Again, we'll go Tim, Sanjay, and Rich, okay?
I just want to thank Marty and the IvyFON conference for inviting us. And, it's a good discourse, good discussion. I think it's good to have it, so appreciate that all around. Gary, to your question about what are you looking at? I like your analogy about the sports where NCAA is being disrupted, where you have the younger kids, younger athletes. It's like name and likeness. You have Pac-12 LA schools moving to the Big Ten. So there's disruption because there's a lot of power in play, and I think you're going to see, as the landscape shifts and new technologies and infrastructures and teams and incentives and things like that get built and evolve, the developers of the future will build it.
Yeah, my parting thoughts. So if you sort of think about the days when you had to call a taxi company to get to the airport, and maybe they had a taxi around or not, and then you went to the next taxi company and so on. Nobody thought that it was possible to have an app and just book your taxi and it shows up where you are, right? I think with Web3, we're going to see something similar happen. Whenever there's something that creates more convenience for the end user, no matter what, eventually it wins out, right? The genie's out of the bottle here. We can, try to understand it. Right now, we may be sort of, in a phase of disbelief that this is all happening, and some of us may say this has to be regulated one way or the other. I think some meaningful regulation is important. The Loomis-Gillibrand bill is a good starting step there. There's a few other kind of crypto bills that are being considered right now. I think next year we will see a bipartisan bill on stablecoins, which will be another good thing. So there's going to be regulation. It'll take time. It'll get there, meaningful regulation. But I do think Web3 is going to make things a lot more convenient to people than it has ever been in the past. And ultimately, this convenience will win out. There's about 80 million or so Coinbase users. Those are custodial wallets. There are people like me who are in their 40s, late 40s, early 50s that may have self-custody wallets, but I can guarantee you that all the 30-year-olds will have self-custody wallets. And in the next 10 years, they will all be 40. And guess what? They're going to be doing a lot more using crypto rails, right? Payments, whether it's sending and receiving payments, that'll happen on crypto rails. Whether it's investment, that's going to happen on crypto rails. So for us, if we are kind of thinking about the next 10 years, and as we think about the 30-year-olds getting to their 40s and how are they going to be perceiving investments, I think it's important for all of us to recognize that and kind of embrace this new world, because there's no going back to Web2 after this, right? We all see the convenience, we all see where things are headed. So I think this is the future. And Marty, thanks for having me. Again, great conference. Thank you all for your time.
You get to wrap it up here.
Well, I mean, for not repeating everything, I'll say thank you, Marty, and thank you, Gary. It was a great conversation, and Tim and Sanjay, entertaining. And I do agree with everything got said by Sanjay here. Just learn. For the new participants, I think there's so much to learning and education. And always digitization is moving forward, and we're going to keep moving forward. Thank you.
Okay, so Marty's going to have some final thoughts before he takes his Uber or taxi to the airport, okay? Or maybe we'll just go over in the Metaverse. Thanks a lot.
Great job. Thanks so much, guys. So I just want my parting thought is that Sanjay really hit something out of the park when he talked about self-custody. Because if we go to a central bank coin and people self-custody, what is the impact on banking, right? So people haven't given it much thought. I think we're in for a lot of regulatory direction from the SEC. I mean, you've seen this with Kim Kardashian having to pay a $1 million fine. And I think those are going to be coming down in a lot more volume. So it's very intriguing. But I just want to remind everybody that we're going to be in Miami for Art Basel. And that will be November 28th and 29th. Tim Draper's going to be there, Phil Darabov. It's going to be a lot of fun, and hope to see you there. Thanks so much.